Howdy, Wall Street Willie. What are the advantages of tax loss harvesting? The biggest advantage of tax loss harvesting is that it helps reduce your tax liability and boost your post-tax returns. If an investor is in a high tax bracket and is offsetting gains from short-term capital gains that are taxed as regular income, the tax savings can be significant. For example, if someone in the 24% federal income tax bracket offsets $10,000 of short-term capital gains, they would save $2,400 in taxes. Even if you don't have capital gains to offset, you can still use tax loss harvesting to avoid paying income tax on up to $3,000 of regular income every year, or carry the losses forward into future years. If you have made a bad investment and want to sell that loss-making or high-risk investment, tax loss harvesting makes the loss more bearable by converting the loss into an opportunity to lower your tax bill while diversifying into more stable investments. What are the disadvantages of tax loss harvesting? Although you can save on taxes in the short term, selling investments without much consideration can hinder a long-term investment strategy by shifting your asset allocation and incurring transaction costs. The process might also be challenging as it requires paying attention to tax rules like the wash-sale rule in order to be profitable. Your loss will be disallowed if you or your spouse purchase the same or substantially similar security before or after 30 days of your sale. Also, there are state-specific rules, and if a state doesn't allow you to carry forward a tax loss, it may not be very beneficial. Similarly, if you are in a lower tax bracket, the potential tax savings may not be significant. Remember, tax loss harvesting postpones but does not eliminate your taxes. When reinvesting your proceeds, you might be effectively reducing the cost basis of your replacement securities, which will lead to a larger capital gains tax in the future. Should I use tax loss harvesting? If you are buying and selling investments frequently within 1 year of buying them and are in a high tax bracket, tax loss harvesting can be a great tool to help you keep more of your profits. But for individual investors who are in a lower tax bracket or are investing for the long term, tax loss harvesting is an unnecessary complication that offers little benefit. This is because of the lower long-term capital gains tax rate and the potential for worse overall performance caused by frequent trading. Thank you very much, Wall Street Willie. You're welcome, Super Cooper. Remember, finance is your friend.